Hi, everyone. Welcome to Crowd Forecast News, episode number 169 for February 5th, 2018. Today we will be talking about the 228th weekly report, which you should be seeing on my screen while I'm talking right now. You can also go to TimingResearch.com and download a PDF copy if you want. For those of you watching live, I do have the live chats section of the YouTube page open, so if you have any questions or comments during the show, you can type them in there. My name is David Kosmeter, and I'm the creator of TimingResearch.com, and I have Rob Hanna back to moderate today, so I'm going to go ahead and turn it over to him.
Hey there. Thanks, David. Great to be back again, and it looks like we got a nice lineup here today. I'll tell you, I guess, a little bit about myself to start for the crowd. I'm Rob Hanna. I'm from QuantifiableEdges.com and InvestiQuant.com. So I work with both sites. Quantifiable Edges I started in 2008. It looks at quantitative research, primarily focused on swing trading indices and individual stocks and ETFs. At InvestiQuant, we do. I head up quantitative systems research for swing trading and for overnight trading, which looks to get in the morning and then out the next day. So a lot of the time frame that I look at is swing based, and that's what we're going to be talking about today, going from today until Friday. A lot of the discussion will be. So that's me. We also have Anka Metcalf with us from Trade Out Loud, and Simon Klein from Trade Smart Forex, and then I think Neil Batho will be joining us as well. Let's let the others introduce themselves. Anka, could you I know we've talked in the past, but you'll do a better job introducing yourself than I will. So give us a little bit about yourself, your site, and whatever else you want to tell us leading off here.
Thank you. But before I jump in, I just want to make a quick mention. I also love swing trading. And I think swing trading is the way to go, especially now with the presence, more and more of presence of HFTs and so on and so forth. I think that swing trading is the way to go. This is the only way us as retail traders can really swim around all the divergence that is happening in the market. So anyway, thank you, David, for having me here, and thank you, Rob. And all right, so my name is Anka Metcalf. I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade, yes, and swing trade, and focus on equities and futures. I have been doing this on my own as a professional independent trader from my home for the last 15 years. Prior to becoming a professional independent trader, I have worked in investment banking for more than 10 years. I am the designer of an institutional proprietary trading system. And what I mean by that is that I took an institutional model and I have applied it for myself as a retail trader. That is slightly different because we don't have the capacity to trade with tens of millions of dollars when we're day trading and swing trading. So I just adapted it for the retail trader. So it would be easier on me to recognize some of the things, a niche that is somewhat not traded by institutional traders, but is seen on larger time frames, and I have adapted them for the smaller time frames, such as day trading. So I focus on price support resistance, and I focus on the 7 layers of price support resistance, specific trigger times throughout the day, and that is especially for day traders with market timing. Also, specific price zones. We have 4 specific price zones where we see buying pressure, selling pressure, and this is specific for futures trading. Also, chart synchronicity and divergence, strict set of trading rules, and a 10-point scoring system that enables myself and my traders to identify trades with ease and have a higher batting average in these trades. Also, for those of you that are interested in following me, or if you want to learn more about Trade Out Loud, you can head to our website, or you could visit our social media sites. I am mostly present on Twitter, where I post tons of trading ideas. For instance, if you follow me, and I know a lot of you guys that are in here are in my training room, I have made an invitation for you today. And we have, I would say, a considerable presence on Twitter. We also had a really nice trade last night, long in the S&P. And I know that we're going to be talking today about the SPX, the S&P 500. Also, you can find a lot of other details on Facebook and Trade Out Loud.
All right. Thanks, Anka. Good to have you back. Simon, what about you? Can you tell us a little bit about yourself and TradeSmart Forex?
Hi, Rob, and thanks for having me back as well, David. It's great to be here again. Hasn't been so long since I was here last time. Anyway, so I'm the, I guess, founder and CEO of TradeSmart, which our website's tradesmartforex.com. I've been a professional trader for over 13 years now, unless this needs a bit updating, but over 12 is also over 13. Kind of keeps includes that. Anything over 12. And basically, people over a number of years ago came to me and asked me to train them. So I trained many people, including some working in some institutions on Wall Street, some banks in other countries as well. So in the banking, so I've trained people, institutional traders, not just retail. So I've been training traders for quite a number of years now, and about 3 years ago, or just under 3 years ago, I decided to take this to a wider audience on the internet and started tradesmartforex.com. And we launched our trading room last year, and we help traders from no experience at all, people starting out, all the way through to a professional level, by teaching them how to read the markets professionally, teaching them how to run a trading business, working with them one-on-one to help develop their own personalized trading plan that fits their own personality and lifestyle. And then following on from that, we have coaching, and we have our live trading room that we trade every day live, and we prepare every day. Every week on Sunday, we prepare for the week. We look through and set up the trades a week, beforehand. And every day we prepare before we trade. And today we had 2 successful trades in the trading room. We made over, I think, 115 pips today on just 2 trades that were in the live trading room. So anyone who's looking to learn how to trade, this is the place to come, and we can help build you, not just technically, we can build you from a trader mindset as well, which we focus a lot on in the trading room, to actually develop yourself in the right way so you're not trading like a nervous wreck, with your heart racing, sweating, and feeling that this trade has to work or your life's on, your whole life's on the line. You can relate to that. A lot of beginning traders start out like that when they take their first trades. So you can't, that's not sustainable in the long term. So basically you need to build the correct mindset to actually trade in the correct way so that you're there for the long haul. So that's what we do with our traders. We take a holistic approach, and we help RD traders develop themselves and be independent traders that can stand on their own 2 feet and attack the market and actually potentially make consistent profits in the market.
All right, sounds great. Thanks, Simon. Looks like you do some interesting work there. We may have Neil Batho joining us from TraderReview.net in a little while, but he's been detained for the moment. So we'll get going ourselves here and start on the first few questions. I'll start off in the same order we just started, and I'll let Anka go first, if that's all right. What we're actually, let's just run through it quick. I'll give my answer, and then we can get into details. But we're looking at what direction you think the S&P will move from this coming Monday's open to Friday's close. Now, we're down from the open a little bit, but I'm still going to say up. I'm looking for it to go higher over the next week, and I'll ask that we get into reasons why in a little bit. But let me just see where everyone stands here first. Anka, are you bullish or bearish on the week?
I think I am bullish, more bullish than bearish, because when we look at some other time frames higher.
Wait.
Yeah.
You don't want to. No reasons yet. No reasons yet. All right.
Okay.
All right. So you're on the bullish side with me. Simon, are you bullish or bearish?
Okay, I'm gonna say up, and then I'm gonna say why. Okay.
Okay. All right. Simon, you with us, or are you taking the bear side? I'm hoping you're saying bear side.
I'm taking the bear side.
Oh, yes. All right. We're going to have some discussion here. All right.
I think the market, I mean, we'll go over it, but I think the market's topped out. I mean, the chances of it moving back up, I mean, this week it could bounce, but I don't think it's going to make new highs anymore. I think the market's kind of pulling on top.
All right. Don't give your whole answer away yet. All right. All right. Let's let Anka, why don't you go first and give us the bull case, and then we'll let Simon counter with some of the bear case. This will be good.
Okay, first off, when I started the year, I took a really deep look into the market, and I went ahead. I hope everybody can see the charts right here. And I went back all the way to 2000, and I kind of like analyzed and see what happened and why we did get the congestion, and where we had, well, pretty crappy year. Let's see, 2015 was not a fun year to be a swing trader, and I remember that very, very well. And in fact, you know, things started to shift a little bit right after election, and that was literally the buy and the jump off. But I went back into my monthly time frames, and I went from these swing highs right here from 2000, actually, from April of 2000, where we hit these highs right here. And then I went to the support level right here, went to this very low that we have marked on April again. It happened on April again. So we had an extreme high in 2000, and we had an extreme low right here on support, which literally, if you look through the chart, it's nothing significant. So we had a high, we have had a correction, we had a bounce up right into resistance, and then we started to melt down, right? And that was in 2009. Well, it was not fun in 2009. Literally, I was trading 2009. I was bearish most of the time. So obviously, when you see the market that is crashing, it's not a really great feeling. But once you take a look and step away from some of the really tight time frames, and you step away, you eliminate some of the noise, you literally realize that all it did was test this prior low right here, do a peakable low, and then it reversed and slowly started to move up since 2009. So that is the beginning of the uptrend. Now, I drew some extensions here to give me some projections to see where the market is heading and where the market is likely going to stop. It was not a surprise for me that this area at 161.8, we had this huge chop box happening here throughout most of 2015 and 2016 until election. And then we broke out above this level right here, the 161.8, which is a very significant level. And I would expect that we're pretty close to hitting the target here, 2910, 29, let's say 2900 to 2910 would have been my ultimate target level for the S&P. I have run the same projections for NASDAQ. I have run the same projections for Dow. However, it was a question of which index was going to run into this resistance area first. And believe it or not, it was the NASDAQ that ran first and really tapped onto that 261.8 level before this correction started. So to me, it wasn't a surprise that in the last 18 trading sessions throughout January, we literally had 16 updates, continuous updates rallied into this resistance area. Now, when I look at the monthly chart, I don't see anything significant here. All I see is we have an inside month. We're still trading within very well within these prior months parameters, January's parameters, setting a high. So for me, this is just an inside month as of so far. Only 5 trading days so far. Not even 5 trading days. We're in the 5th day.
Great, yeah.
February. So very few days. So I wouldn't consider this. I wouldn't consider this alarming. It is still trading within the same parameters. It depends on what time frame you're trading, whether you should be panicking or not. But I'm not panicking. I still have some long positions, and those long positions are doing very well. Even a pullback to the 2600 will still give me a bullish bias continuing further. This is a monster trend, and bull markets do not end as easily. So once we get started, it's just a matter of continuing higher. From the smaller time frames, the S&P 500, on Friday we had the big flush bar. We're having a little bit of difficulty here, but this is the first tap on the 10 EMA. So rotations may happen off this point. It's just a matter of where we close today. Because if tomorrow and then if the overnight trading session, we're going to trade in the upper side of this range into the 2750s back again and take off this high, we're off to the races again. So this is my take on the S&P.
All right, great. Interesting. Simon, you're looking at it thinking we're hitting the end of it here, though, and perhaps due for a bit more of a pullback this week. Is that right? Want to expand on your thoughts?
Okay, so let's take a step back. I'm a completely technical trader, not technicals in the traditional sense. I've got one indicator that I use for a certain type of trading, the CCI, but primarily I'm looking at Japanese candlesticks, and that's it. Okay, everything's based on supply and demand and basic on how the market moves. So let's take it step by step from the monthly chart down, and let's analyze this. There's only two ways an uptrend can end. Yeah, especially when it's making new highs. We're still in an uptrend here on the monthly chart. One of the ways in which it ends is the trend actually ends. It fails to make new highs. It pulls back and fails to make new highs, and the trend ends that way. Yeah. The other way it can end is exactly what we're seeing happening now, where we've had a very sustained move to the upside, and then a sudden surge to the up. This is like running the marathon. This can carry on forever at this rate. Yeah, but once you get that final, I talked about this a number of weeks ago. Once you get that final surge to the upside, that's usually, who's on the other side of those trades, who's taking profits on that surge up. Yeah. See, after that, I think it's institutions primarily taking profits on the surge up. I think this potentially could be the top. I don't think we're going to see new highs, potentially not even, maybe not this year. But again, I would put like around an 80% probability that this is probably the top for now. Yeah. Now let's take it down a time frame, and you can see it more exaggerated here. Here's this kind of steady move, and then we kind of the rate of ascent. This is the beginning of 2018. We've had like 4 months up, and this bar completely taking out two and almost. We're down below almost 3 weeks of buying. So anyone buying anytime at the beginning here is now underwater.
I'm sorry, what is this, weekly bars you said?
This is the weekly bar. Yeah.
Okay.
So anyone here sitting today now who bought after the first week of the year, from the second week of the year on in January, is now sitting underwater. What are they going to do when you see this bar as well? If you go more into, again, there's something that you won't find in any book anywhere, something I've been looking at and analyzing for the past 13 years. Yeah, I'm looking at the charts every day. This bar is not a pullback bar. For me, this bar puts in the high. There's a difference between a retracement and the top. This bar looks to me that it's a top. And you can go back again. If you look at the bars down here, the difference between a bar down here is that we're low down on the curve. We're at all-time highs here, and we've just had this surge to the upside. It's a bit like running a marathon and then doing the last 100-meter sprint. For me, that's the top. Now, at the moment, we're moving to the downside. No one can argue with that. The question is, are we going to hold? Now, in uptrends, what happens is when you're in upward motion, the market hits supply, pulls back, and then moves to higher highs, moves to new highs. That's the definition of an uptrend. When you hit the top, yeah, we're still uptrending here, but I'm going to show you on the daily chart something different. Once you hit the top and you go down, once you hit demand, the true test of this is when we hit the first demand level, which is really down here on this time frame. Yeah. If that move up fails to make new highs, we break the uptrend. And that puts us, yeah. So in downward motion, when you hit a demand zone, the moves up are sellable. We may bounce to the upside, but it's a move up that you don't particularly want to buy. You can buy it, but it's going to probably be short-lived. So again, in uptrends, move down to demand are buyable. Yeah, when you hit the top, moves down to demand are giving you an opportunity to sell on that move up. So I think that if this moves up, which it could do, it's probably a sellable event that's going to happen. Now let's have a look at even lower, even on a lower time frame. Now we were looking at this last week, and if I just adjust the lines here just to make it easy to see, yeah. Last week, this was the last pivot low over here. Now you can see what happened. How do I know this is a top? Most likely, the trend breaks on this move down, and we couldn't get back over this demand becomes supply zone. And look, we go sideways here, and then boom, Friday we sold off. And we're continuing now. This is not in an uptrend anymore. It's broken the trend and we're moving down. Where's the next area of potential buying opportunity? And again, I'm not looking at moving averages. Moving averages and all these other types of indicators are just self-fulfilling prophecies because a lot of people use them. If you look at the charts, you can start to see where there's real demand in the charts, and the next real demand zone is really down here. There's nothing here. This is tradable void. There's nothing to stop the market apart from if it does. Again, we're talking about what happens the majority of the time, what the probabilities are, not what's going to happen this time particularly. Yeah. So this is most likely to continue dropping down to probably this level, whereby it's probably going to bounce to the upside. Yeah. And that move up is probably giving opportunity to those who are still on the long side to potentially get out, which is why moves up get sold when you start to top out. This is not looking like this is not looking like a pullback to me. This is looking like a top. Okay, so that's basically the reason why. If it does move up, it may do. I'm going to be selling that, not buying it.
Okay. All right. Understood. So it's interesting with Anka's fibs are looking a little bit different than Simon's candlesticks, and I'm looking at things a little bit differently. Let me share my screen here. So most of what I do is based on quantitative analysis. So I'm going to show you some information. This is from the InvestQuant Swing Navigator newsletter that I write each night. And this is our swing edges 1, 3, and 5 day time frames. And what we publish here, win rates based on historical odds of being in similar setups. So we define those setups with our systems. We have 9 systems we look at. They look at a 1, a 3, and a 5 day time frame, and they look across what we refer to as acceleration, which is how fast is the market moving, and where is it coming from, this move. In this case, it's moving fast and it's coming from the top, right? Momentum, how persistent is the move, and then also where is it coming from, and then seasonality. So based on those systems, and the 1, 3, and 5 day looks at them. Actually, it's 9 separate systems that look at 1, 3, and 5 days. Our average is showing that 3 days out, we see a likelihood of a little over 60% that we're going to be higher. 5 days out, which is the real question that we're looking at today, versus this past Friday's close, 62% we're saying that it would be higher. Profit factor is the number here. That refers to, it's a system term that says how much would you earn in gross gains versus lose in gross losses over time if you trade it off of this. So it's near 2, which means you'd be making about twice as much in gains as you have in losses on a 5 day. We also break it down by the system types, so acceleration, momentum, and seasonality. And the nice thing here is that they're all showing a bullish tilt. If something shows up as a 55 and at least a 1.3, I highlighted in green. So we see all 3 of them have done that. And 6 of the 8 index securities we track are also doing that. That's the 4 major futures and their corresponding ETFs. Is what we're looking at here. So ES is showing strong.
Hey Rob, you're not sharing your screen. If you meant to share your screen. You're not doing.
Okay. Sorry. I thought I was. Here's the look there. Can you see it now?
Yeah, looks good.
Okay. All right. So we're looking at somewhere about a 60% chance. I'm sorry, here's the 5-day, 62% chance of a move higher. For ES, we're saying 62 also, and about a 1.6 profit factor there on average. Actually, it's a 2.0 for the 5-day. All right, so that's where ES is at. SPY is showing similar numbers as you would expect it normally would. And for all of the index securities you track, it's a combination of a 65 and a 1.92. So a little under 2 to 1 that you would make to lose. Now, I looked at some individual studies that I thought I would share with you as well. And just, I'm going to show you a couple of interesting ones here from my weekend research. The move down on Friday was as big as we've seen in a long time. It was over 2% drop for the S&P, which I think it was 2016 was the last time we saw that. In any case, the VIX spiked when this happened. And I looked at VIX spikes of more than 20% on a Friday. Fridays have generally been renowned as days where sell-offs will really, people will overreact more than others. Part of this perhaps is because people don't want to take on weekend risk. Part of it perhaps is because people fear the Monday crash, right? The crash of '87, the 1929 stock crash. A lot of the stock crashes have happened on Mondays. So for whatever the reason, Fridays tend to have larger overreaction. So I looked back and saw other times the VIX rose more than 20% on a Friday. If you buy the S&P and sell however many days later, there have been 18 instances. Interestingly, all 18 closed above the entry price at some point in the next week. Looking out 4 days, it was 14 and 4. Now, what was interesting to me was the 1-day and 4-day profit curve. So this is a 4-day profit curve, right? So it's nice, steady rise, meaning that the edge has been in effect for a while, and it still appears to be in effect. The 1-day profit curve looked substantially different, in that it has struggled in recent years. So this suggested to me that, well, perhaps Monday may not get the bounce, but still, sometime over this week, we should see that bounce. And so that's what I'm looking at. I'm seeing it from a few different angles. Also saw it in the fact that it was this study just along the same lines. S&P closes down more than 1.5 times the previous day's 20-day average true range. So that means it's a big drop lower. This one looks out 1 day and 6 days is where I highlight the curves. And we see a similar phenomenon here, that the 1-day Monday used to be really reliable for a bounce. It hasn't been lately. But if we look at the 6-day curve, that's remained reliable. So we may not get the bounce today, but we should get it within the next few days is what I'm seeing here. Now, beyond that, I don't have a lot telling me whether this bounce is going to peter out or whether we're going to continue the uptrend and move to new highs. But for me, looking at this particular week, I'm looking at a move higher from today's open until Friday's close. Let me stop the screen share if I can. Did I stop it? There, I think I did.
Yes.
Okay. All right. Let me go back and see. Well, actually, I did want to point out that the Timing Research crowd forecast indicator today is forecasting a 58% chance higher for this coming week. So that's also looking at a potentially higher move. Last week there was very high sentiment pointing higher, and the forecast indicator suggested maybe it was too much sentiment, and we were headed lower, 53% chance lower, and that certainly worked out. So the Timing Research forecast was dead on last week, and if you're bullish, hopefully it's right this week. Anka, is there anything that you're particularly concerned about this week that could throw off what you're looking at, whether it be something fundamental or announcements, technical levels you're worried about, anything that would have you say, hey, you know what, this could be more trouble than I was anticipating here, and we could get more selling?
Not really. I mean, I'm just observing and seeing here how everything is tapping out. There's a lot of selling pressure, and I see that. However, I'm not overly panicked, so I'm hedged. I know we're going to be talking about this, so I do have some VIX that I have long, and I threw out a majority of them on that bounce this morning, but I still have some left in my portfolio. So I'm not very concerned on this move, and I don't see this this move as a panic sell at all. So there are still plenty of stocks throughout the board that are holding very well. And in fact, right now, let's take a look at NASDAQ. I was just looking at NASDAQ. It really did not make, and I was looking at the hourly chart, it didn't really make new lows. So it's still holding. Oh, okay. I'm not sharing I'm not sharing the screen. Okay, here we go. All right. So NASDAQ right here, we had the overnight low at 66.82. We're still holding this this area right here. So I'm not very concerned with the sell. In fact, I kind of like what's happening right now in the market because, price is equivalent to opportunity, and where others see fear, I see a lot of opportunity happening. So, for instance, the Dow. Okay, the Dow. I'm going to take it to the daily chart right here. In fact, this is not a good chart. Okay, hold on just 1 second. Let's see if I could get a better chart. Not really. All right. Okay, I don't have all the moving averages here as well, but I'm going to look at this minor support level right here. 24,901 in the E-mini Dow. 25,059 is where the 50 SMA is, and usually in very strong markets, we've had some very strong rotations off of that moving average. There are a lot of technical traders out there. I know just a few hedge fund managers that are literally just doing the yes, it's finally here, so we're gonna just buy some more. So this is a really good opportunity here for a buy, but obviously I'm going to need confirmation. I'm not, trying to capture a falling knife, so I'm waiting for the whole movement to end. But this is a really good reversal opportunity right here in these in the indices in general, and even in stocks. There are some stocks, and this is just, hey, you know what, news flash, markets do pull back. I mean, if if there are any new traders that
they haven't for the last year and a half.
Exactly. Exactly. So it's like, hello, markets do pull back, and this is what a pullback looks like. I mean, this is what happens, And in fact, there are a lot of technical levels, and I'm an extreme technical analyst and technical trader. And I was very aggressive, and I took some trades even yesterday right off the open that were beautiful throughout the overnight. I took the E-mini S&P long off the 61.8 fib, and it did beautiful. And so I repeated the trade this morning on a revisit of the prior lows. So technical analysis really does work. Not concerned one bit with this correction in the market. Is just a correction. And even if it pulls back, let's say even 1,000 points in E-mini Dow more, we're still in a very bull uptrend. So we just need to take it, one day at a time and adjust our entries with what happens in the market. But other than that, I'm very positive that it's a really great market opportunity. So yeah, that's
all right,
pretty
great.
much it.
Simon, what about you? Anything that would that you're especially looking at this week as far as news events or technical levels that would have you change your mind, or fundamental factors in the market that have you concerned?
I don't really look at fundamentals. I stopped doing that quite a number of years ago, as we've talked about in the past, because I didn't find it gave me an edge. I used to when I first started trading, I traded on a trading floor I was trading the New York Stock Exchange, and I was a member of the New York Stock Exchange and Philadelphia Stock Exchange, and we used to get into the office like about 3 or 4 hours before the US market open, like at 9:30 in the morning. So we used to be in the office like at 5:30, 6 o'clock in the morning, basically. And we used to go through all the fundamentals and earnings, and we used to look at balance sheets and all that sort of thing. And we had some forensic accountants who were trading with us and all these skills. So basically what it boiled down to was that analysis would give us what would be in play for the day, what's probably going to be volatile and moving, but it wouldn't really tell us which way it's likely to go, because sometimes it was good, you look through all the fundamentals and it will tell you up, but yet the stock sold off the whole day. And sometimes, there were great news, the market gapped up and sold off the whole day, or sometimes it was bad news and the market just went up the whole day, or likewise good news and down. So basically what I decided to do quite a number of years ago is that doesn't really give me, because there's people out there that know how to do that much better than me. What's the one thing that I need to focus on in order that doesn't lie? The charts don't lie. The charts tell you exactly where money's going. If the market's going down, then the market's being sold. If it's, there's more supply than demand. If you look at it, the supply demand equation. If the market's going up, then there's more demand than supply. There's more willing buyers at every level than willing sellers. Otherwise, it wouldn't be able to go higher. And that's how, if we look at the bigger time frames here, the monthly and the weekly, we're still in uptrends. Yeah, we're still uptrending. It hasn't broken. It's only the daily time frame that's broken. And if you look at the smaller time frames, like the 4 hour, 1 hour, then we're probably kind of moving down in downtrends. Yeah, we started to move on the downside, which is that's what a pullback looks like. A larger time frame pullback would look like a downtrend on a smaller time frame. So the only thing is, it's hard to sell after a big move down in price, close to demand zones. Yeah. So the right way to play this on the short side is not to get in now on the short side, unless you've got a smaller time frame in which to do it, is to wait for a bounce to the upside that fails to make new highs. And that would be kind of confirmation that this is a market top. We still don't have that quite yet. So that would be the one thing that I'll be looking for, is which level it's gonna, if it goes through the next demand level, then it's all over, it's going down.
So you bring up a good point there, and it kind of leads us into our next discussion, which is hedging, right? I mean, now it's not exactly the time to hedge when everyone's already been selling for 3 days. But if we get into this bounce and you have long positions and you want to hedge them, then that would probably be a good time to do it. Before we get into that, though, let me just mention 2 things that I'm looking at that are most concerning to me as far as from a bullish standpoint. One is, I'll start with the lesser of the 2 first, and that's the fact that as we were reaching the top here in the last several days, or what is currently the top, it may not be the ultimate top, but we had some Hindenburg omen signals going off, which basically is it's a term, or it's a signal created by Jim Micah in the 1990s, I think it was, and it basically it identifies split market environments. So you're near a top, you've got some poor breadth, and you've got a split market, meaning there's a lot of new highs being made and a lot of new lows at the same time. So it indicates that not everything is healthy and the market could be due for a pullback. The record of the indicator has been so-so in recent years, but I think it's still something that's worth paying some attention to. And it did signal last week a few times. It's when you get a cluster of them that it's more important. And we did get a little cluster of them. I think there's been 4 in the last couple of weeks. So some level of concern on my part there. The other thing is the Fed. the Soma account last week. They report every Wednesday the changes in their, they call it the Soma, System Open Market Account. And they have an edict right now to, or a policy to reduce it by about $20 billion a month. Typically when it has been in a reduction period, the market has struggled. Now, they started reducing it by 10 billion a month in early October. That moved up to 20 billion in January. Once we hit April, it's supposed to go to 30. And then July 40, and next October it would move up to 50 and stay there. That's a big amount once it gets to that 50 level. Right now, it's been a fairly small amount. It hasn't seemed to really hurt the bull market. But last week, we had the biggest move lower since in the Soma since Operation Twist in 2011. It was reduced by $21 billion just last week. Now, it was playing some catch-up because it hadn't been reduced all January up to that point. In fact, it had expanded a little bit. So maybe that's creating a little bit of a liquidity event. I don't think we're going to see chunks that size most weeks, but it's something to monitor going forward as we get further into this thing. And if a correction comes, I think the Fed will be helping that correction. So we'll. I'm continuing to monitor that, and I monitor it each and every week in the Quantifiable Edges newsletter. So let's get on to the question number 4, and I'll let you start, Simon. And the question is, what sort of hedging or portfolio protection strategies do you implement in your trading or investing?
I don't really do that. I basically every trade I take has a maximum money loss that I can take on it, and I primarily use stops and put them in places where they shouldn't get hit if the trading idea is still intact. So that's how.
Well, I mean, it's not necessarily a hedge, but it does qualify as portfolio protection strategy. So that's yeah.
I use protective stops and make sure you keep your risk down so that if there's some slippage sometimes, then it's not going to take you out the game, so to say.
Right.
So that's primarily what I do. Sometimes what I can do as well, if I've got a long-term position on, for example, say I'm long the market at the moment, and I believe that this is a correction, for example, then I'll play on the short term on the short side and keep my long position open, and that's kind of a natural hedge.
Okay.
Can be long and short at the same time.
And then you mentioned you have stops in place on your positions and so forth. Do you do you set limits on the number of positions you'll take at any one time, or the number of trades that you would take in any one day? You know, if you get stopped out on one trade, are you taking another, and you get stopped out on that, you're taking another? I mean, how many trades would you, or I don't know if that's even a real, you know, how many trades you typically take in a day, but
that's a good question. That's a good question. So I generally will be in, as if I'm day trading, then I'll be in a maximum probably around 3 positions at once. You know, It doesn't mean I'm going to be. The maximum's around 3. It depends on what, if I'm in position, because I don't want to risk. I mean, again, a lot of people out there say, one of my accounts, I risk per trade 0.25%. Now, I know a lot of people out there say risk 5% per trade, which is kind of a bit ridiculous in my opinion. If you go through 4 losses in a row, we'll talk about this before in the trading room, then you're down 20%.
Yeah, you're hurting.
You count, yeah. But if you're risking 0.25% and you have, you know, like 5 losses in a row, I think you're down 1.25%, and that's easy to. That doesn't, you know. So again, it's the
difference between hitting a bad shot in golf and a bad shot in tennis, right? You hit 2 shots into the woods in golf, your whole day's ruined. You hit 2 bad shots in tennis, you're down love 30. Yeah.
So you want to basically trade at a level that you know it doesn't matter whether the trade makes you money or not. You're looking, because one trade shouldn't make any difference. It's how you look over a number of trades, and that's the important. And I think one of the biggest advice I would give to anyone is have a maximum money stop per trade. I just had a coaching session with one of my traders, and we proved that, you know, if she would have taken every stop at the maximum loss per trade that she was taking, just religiously go across and we look through the trades in January, 350 trades. If you would have just cut, which we did, we went through all the trades and cut them at 25 or whatever it was, at whatever the maximum loss was, she would have made 7 times more profit than she made in January, just cutting those losses. Remember, there's 4 options for every trade: big win, big loss, small win, small loss. So long, and this is a very important lesson for anyone listening to this, if you can cut out those big losing trades, as in anything more than your maximum loss per trade, you should be okay, because most people manage to get winning trades. And then once you've got that under your belt, that you've got that down, then you're not going to have one losing trade that's going to wipe you out. Yeah, or that's going to ruin a month of hard work. Then you can concentrate on maximizing your winning trades once you've got winning trades. Again, everyone tries to do everything all at once. You need to focus on different, at different points in time in your development as a trader on different things, and not try and do everything at once. So that's the biggest thing that you need from a risk management perspective, is make sure you're not over, you have a maximum loss per day. Keep your when you're starting out trading, start small, so that you're not sitting on the edge of your seat trying to make a living out of this one trade. If you go and look at lots of little wins over time will make you a living if it's sustainable and consistent. If it's not sustainable, big wins and then big losses, you're going to be all over the place, and you're never going to get the consistency you want in order to make consistent profits in the market. So risk management and hedging and this whole concept is so important. Come up with a maximum loss for your trade that's small and stick to it. That's the one bit of advice I'd give to everyone. Yeah, good advice. Anka, what about you? Do you what sort of hedging or portfolio protection strategies do you implement in your trading or investing?
Okay, I'm a day trader, and primarily I day trade futures, and I only trade in the first 2 hours, so I don't really need to hedge anything from the day trading perspective. But I am a very strong swing trader. In fact, I take on a lot of positions. Not far from last week, I had 37 positions on, so I do trade heavily, swing trade heavily. And when I'm swing trading, I'm always protecting with stops. I don't use hard stops. I use flex stops, and I let the technical analysis dictate my stops. So that means that I may give in a little bit more. If I put in hard stops, I've noticed many years ago, and especially in that chop of 2015, that is where it was a real good lesson to learn, because that was the time when I have adjusted my method. And it's not the method where I have learned that, having a hard stop and having a stop set in stone is not going to work for you, because you are having the morning fleecing in the stock market. Stocks are up, stocks are down, especially in earnings season, and you're going to have that fluctuation. So having a flex stop, knowing your support resistance levels, those 8 technical key levels that I'm looking at with the and knowing how the pullback is happening. I usually don't do anything in my swing trades in the first hour in the morning, and I look for hourly reversals in case before adjusting my stop. So I use the VIX to counter position. And in fact, I did trail out the majority of the position that I had on in VIX, and it was a phenomenal trade. And it keeps me protected. And that is, if you're a swing trader, you definitely need to protect your capital, and one or the other, you got to hedge somehow. And I think that it comes number one. So having the stops, definitely, because without having a predefined stop area, you're not going to be able to determine your risk. And because the risk, definitely for our audience that is tuning in, the risk is the difference between your entry and your stop. And based on that, you can position size, whether you want to take, like Simon said, 0.25%, or whether you want to take 2%. I risk 2% for each trade. And I have a predetermined risk for each trade, predetermined position size, not position size, risk money-wise. But if you're a beginner trader, you could go as low as you can, because it's nothing is going to be better than trading, real money. Because if you're going to be in a simulator stuck for, 3 to 4 months, you're going to become very comfortable because you don't have any emotions that are going to be involved. So yes, I do use the VIX and to hedge and some other instruments as well. But these are actually, and this is the VIX right here. I had a target at 33.67 right here. It jumped up and gapped up this morning. I trailed out based on an hourly here onto the top here into the 10 SMA. And when I saw that this rotation is not happening from this point on, this was the time to trail. And also this morning here, I trimmed some more into the 29.55-ish area. And right now, if we're going to take these highs here back into the, oops, sorry about that. This is my trim area. I'm sorry. This is my trim area, the 33.27, and it depends. I mean, you have to. I still have a very, very small position. I think we're overbought here in the VIX, but
yeah,
VIX is something that I adjust with.
Great, thank you. That's some good ideas there. As a swing, so it depends on the kind of trading I'm doing. Like you guys, I don't do personally. I don't do a lot of day trading, but I do have overnight trades, and I do put stops in on all those. So, and it largely that's because I'm trading futures with those, right? I do have some ETF trading I do there, but it's not with the same leverage. You need stops if you're using a lot of leverage. If you're not using a lot of leverage, you don't necessarily need to put a stop in place. You can wait till you can let the trade play out. So if I'm going long ES in the afternoon, looking to get out the next morning, then I'll have my my price stop in, and then the time stop is always the open the next day for my overnight trades. For my swing trades, there's a few different ways I look to do it. Some strategies I do not use stops on, but I use very strict money management. So if I'm not using stops, I'm going to be taking very small positions there. And if they drop a huge amount, it's not going to kill me, right? If I take a 1 or 2 or 3% position in a stock and it drops 20%, it's not going to kill my portfolio. And then there are times where I do use stops in my swing trading. If I'm taking large positions, I will test out reasonable stop levels, and I normally use percentage stops. So I might take a 1.5% stop, or a 3% stop, or a 5% stop if I want it just to be an extreme stop level. But my general rule is if my system says let's buy a pullback, and whatever the trigger is, I go ahead and buy that pullback, and then I get stopped out, say down 3% or 4% or whatever it is, then it doesn't matter if the system triggers again. There's no way for me to get back in once I'm stopped out until the market resets. So for me, a lot of times the reset is it's got to bounce, right? So it needs to make a 5-day high, or it's got to close above a 10-day moving average or something like that. And then after that happens, I'll look at that as a reset and then think about, all right, when my next swing triggers, I can look to take it. So those are some of the things I play with as far as hedging and portfolio protection. A lot of it's basically just position sizing for me. We're getting near the end here. I want to give everybody a chance to just tell us anything that's going on at your site. Give a trade idea if you want to, and anything else you want to let us know. We got 2 minutes each to do this. It's 1:54. Anka, you're on the clock.
All right, so I have a trade idea for this week in Caterpillar. If Caterpillar, CAT, ticker symbol, is going to trade above 159. I like this bullish for a continuation higher. Very, very strong stock. And I like a run into the 165, 170, and 173, this all-time high at the least. Stop will be considered the risk into the 152. So I like a reversal off of this 50 SMA. It is also where the price is trading right now, is really tapping into this prior support level right here that it was trading on January 3rd. So I really like a rotation off this point for higher. And if any of you guys in here listening, if you want, if you would like a trial to our day trading futures room, feel free to email me at info@tradeoutloud.com. I have some very affordable rates for trials. So thank you so much, Rob, for hosting today. It's been a pleasure to see you again and to speak to you. I love your analysis, by the way, and thank you so much, Simon, and all the guests in here, and David for putting everything together. So thanks so much, guys. I'll see you next time.
Thank you, Anka. Great getting to talk to you again. And I'd encourage everybody to check out your site there as well at tradeoutloud.com. Simon, how about you? You got a last trade idea or a and if there's anything you want to let us know about your site, any special offers or anything, go ahead and let us know.
Okay, thank you, Rob. Again, great to be here. So you can go to my site, and if you want, sign up here, and you'll get a 15-minute video on how to build a profitable trading strategy, and it goes through it step by step, the steps that you need to go through in order to do that for yourself. And behind, you can see, very briefly, you can see this is Bitcoin futures, and we basically said sell, and we're still on the sell side in our trading room or whatever, and it hasn't bottomed yet. So we'll look for a buy opportunity when it kind of bottoms out. But since this contract was started a few months ago, it's just been going down. We had a bit of stabilization, but you can see it's in a you can see even the intraday downtrend over here. So, and we've just reached all-time lows since the highs were at 6,930. It could go down more again when markets are falling. They continue until they kind of stop or change trend. Now, what we've got as well, just following on from that, we have a webinar tomorrow that I'm doing with Mike Greenberg. Mike Greenberg helps me run the trading room. He's been with me since 2011. And you can go to my website and you can sign up for that. The link's over here, Introduction to Bitcoin. And we're going to be going over exactly what Bitcoin is, what the blockchain is, and why is it important to know that now? Because a lot of the way business is done is changing. Blockchain's here to stay. I'm not so sure about Bitcoin. I mean, there's many other what you call altcoins, alternative currencies. There's Ethereum, and I could mention there's hundreds of them. Yeah, but the actual technology, which is all built on and the Bitcoin was the first proof of concept of the blockchain. Yeah, is here to stay. And again, if you want to learn more about that in less than 23 hours and 2 minutes time, tomorrow at 1 p.m. Eastern time, come and sign up. It's an amazing webinar. You'll get the background you need in order to understand exactly what it is. Again, thank you so much, David and Rob. It's great to be on the show, and great people. Thanks, Anka, and as well. Okay, thank you.
Thank you, Simon. And again, I'm Rob Hanna. You can find me at investquant.com or quantifiableedges.com. I'd encourage you to go to both sites. Free trials are available for the Quantifiable Edges Gold subscription, which includes a nightly newsletter and systems and a lot of other things, or the IQ Navigator at the InvestQuant site, also a free subscription there. So I would go ahead and check them both out, see if either one of them fits with how you trade. And if it does, terrific. If it doesn't, you've wasted nothing more than your time, I guess. Sorry about that. Anyway, that's it for me. Thank you very much, David. Thanks to Simon and Anka for joining me again here. And it's always a pleasure getting to talk stocks and markets with you guys. Oh, my trade idea. Long S&P. I'm looking for a bounce in the next few days, and I will probably get out when it's closed up either a few days in a row or above short-term moving average or something like that. But I'm long right now, and may scale on a little bit further, and I'll be selling into a bounce. I'm not looking to hold it for a long-term trade right now, but that's my trade idea for the week. Thanks, everybody.
All right, thanks everyone. Great show. For everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, be sure to join us tomorrow night, February 6th, 9 p.m. Eastern Time, for Analyze Your Trade, episode number 22. And you can always get the access to the live shows at TimingResearch.com/live. And just want to thank all my guests again for this week. Anka Metcalf of TradeOutLoud.com, Simon Klein of TradeSmartForex.com, Rob Hanna of InvestaQuant.com, and Neil Batho of TraderReview.net was supposed to join us, so we'll try to have him back another week soon. So thanks, everyone.